It's time for the Your Personal Bank Show with Ferenc Toth. In an era of chaos, confusion, and craziness, Ferenc is a voice for common sense. As a financial literacy educator, speaker, and entrepreneur, Ferenc cuts through the noise to help us understand how current events affect our money, economy, and our freedom. Now, here's Ferenc Toth.
Welcome to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Email Ferenc, F-E-R-E-N-C, at yourpersonalbank.com, or 866-268-4422. Yes, you will reach me, not an assistant. Today I'm going to cover why this is the best time in 40-plus years to consider an annuity or transfer your existing annuity. The reason I'm doing this is because so many of you have reached out to me. There's been a tremendous amount of interest, questions, misconceptions. A prospective client recently did an AI analysis on annuities, and I wanted to address the factual information, some of the missing information and misconceptions from that AI analysis, and many questions that I get on a consistent basis. This is going to be the type of show that if you have any interest in learning more about annuities or having a greater understanding, you might want to take notes. If you email me at ferenc@yourpersonalbank.com, I will send you a copy of this show and or the transcript, if you prefer, that you can have for yourself or pass on to anyone that you think may have an interest. Before I go into why this is the golden era of fixed assets, some of the best index and income annuities I have seen in my 27-year career are currently available, and why it's the best time in over 40 years, literally, to consider an annuity, or if you currently own annuity, why it's likely the best time to transfer it to increase returns. I want to give you a little bit of my background, not to brag, but just to give a little bit of credibility. As I stated before, this is now my 27th year in the financial world, representing and selling annuity products. I have been a top 10 annuity producer nationally for some of the largest annuity companies in the country multiple years. I was an agency owner for over a decade. I have trained over 100 agents in my career. I've personally worked with well over 1,000 clients in my 27-plus year career. I was the former annuity rep for the American Medical Association for the state of Arizona for a couple of years. The AMA would send out invitations, and I would typically have about 20 physicians and their spouses attend a workshop. And my job was to educate them about annuities, life insurance products, and other asset protection methods that would benefit them financially. I got the very rare opportunity to be on a product design team and actually create an annuity product for a major insurance company. This product design team involved 3 agents. I was one of those 3, the head of product, the head actuary, and the chief legal officer of the company. It was about a 2-year process where we dug under the hood every detail about creating an annuity product from scratch. Not many people in the industry have had this experience. Even though I had already been a top annuity producer prior to this, it turned out to be a tremendous learning experience. Over that 2-year period, the 6 of us developing that brand new product from scratch, I got to understand every detail under the hood of how an annuity product operated, what were the strengths, what were the weaknesses, how to identify whether an annuity was likely to produce strong returns or not. Also, I was formerly chairman of the board of an FDIC-insured bank in formation, in which we, at our board meetings, often discussed annuity and other life insurance products as investment tools for our bank and future bank customers. I'm not sharing all this information to brag, stating it as a matter of fact and to establish some credibility. Frankly, there's very few people in this country that have more experience with index annuity products than myself. So again, this will be a great show to take notes, pass on to others, and if you do want a copy of this show or the transcript, email me at ferenc@yourpersonalbank.com. This will also be posted on our website, yourpersonalbank.com. So let's get started. Why is this the best time in over 40 years to consider an annuity or transfer an existing annuity that you already own? The best index and income annuities I've seen in my 27-year career are currently available. The highest returns ever seen in my career. We have products that have averaged 7.5% to 15.5% average annual returns over the past 10 to 20 years. These are average annual returns over a decade period of time or longer. And yes, we have had clients who have received up to 27% returns in just 1 year. There are products with signing bonuses of up to 26%, some even higher, for people up to age 89 in most states. When I mention a signing bonus, I'm discussing a cash bonus, one that is credited and increases your account value day one, not an income bonus. Income bonuses do not increase the cash value or the account value of your annuity. They only increase the income value or the amount of income you can receive from your account. It's not money you can withdraw. Also, some of the highest guaranteed lifetime income products are available that I've seen in my career. There are 8, 9, 10% guaranteed annual income increases. It's known as a rollup. So if you're looking to create a guaranteed lifetime income, you can fund one of these guaranteed lifetime income products and guarantee an increase in your income each year you defer by 8, 9, 10% per year. So if you're looking to maximize guaranteed lifetime income, a relatively small amount of money could generate a tremendous income down the road for you. Also, there are bonuses on income products, upward of 45%, available in most states. Again, it's not a cash bonus, it's an income bonus. I will delineate the difference even further. This brings up one of the most common misconceptions I run into, first and foremost. When someone is considering annuity or looking at it or asking questions, one of the first questions I have to ask is, what type of annuity are you referring to? Most people are not aware that there are over a dozen different types of annuities. There are fixed index, or what I call growth annuities, or guaranteed lifetime income. But there also are immediate, multi-year guarantee annuities, fixed annuities, variables. There's hybrids of all these types of things. There's at least a dozen different types, and they're designed to do different things, depending on your financial goals, what you want to accomplish, your stage of life, the accumulation phase. In other words, are you trying to maximize contributions and growth, or are you moving into or in the distribution phase? In other words, you want to maximize income for retirement, for example. These are very different things. Very different financial goals, and different tools fit those the best. Analogy I often like to share is, if you tell me that you want to hammer a nail and I hand you a saw, is it the saw's fault that it's not very good at driving nails? No, of course not. You have the wrong tool. A hammer is designed to drive nails, and if you want to cut wood, you need a good saw. It's not the tool's fault that it was not able to accomplish your goals, or not nearly as efficiently as it should have. And one of the most common challenges that I see with people who happen to own annuities is they have the wrong type for their stated goal, or their financial goal has changed. Oftentimes moving from accumulation when they're still working to retirement where they want to maximize income. It's not necessarily the tool's fault that it's not working properly or most efficiently for you. It's a bad fit. It's a round peg in a square hole. If you and I meet, or you send me some information, I can quickly help you identify which tool is probably the most likely best fit for your particular financial goals. What I find in the vast majority of cases, most people are interested in the fixed index or growth annuities, as I call them, or guaranteed lifetime income annuities to guarantee income for life. I'm going to encourage you to stay tuned in the next segment, as I'm going to go into some specific details about these types of accounts. What are their strengths and what are their limitations? And lastly, I'll discuss some of the common questions, misconceptions, and an AI analysis that was done and sent to me by a recent prospective client. I believe you'll find this very informative and educational.
Stay tuned for more common sense from Ference. For more information, contact parents at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422.
I'm Ference Toth, host of the Your Personal Bank Show. This is the golden era of fixed assets. Annuities and guaranteed lifetime income are paying the best rates in over 40 years. If you looked at annuities over 2 years ago, the numbers have increased significantly. If you own an annuity over 2 years old, the new products can not only pay your penalty to switch, but are often guaranteed to outperform your current product. For more info, contact me at yourpersonalbank.com or 866-268-4422. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Email Ference, F-E-R-E-N-C, at yourpersonalbank.com or 866-268-4422. And yes, you will reach me, not an assistant. Today we're discussing why this is the best time in over 40 years to consider an annuity, or if you happen to own one, to likely transfer your existing annuity to increase or maximize returns. I shared some of my background in the previous segment. This is my 27th year. I'm been a top 10 producer nationally with some of the largest annuity companies in the country, multiple years. Been part of a product design team with a major insurance company in which we created a brand new product from scratch. I worked with the head actuary, head of products, chief of legal to create this product. I've been blessed with more experience and understanding of annuities just about most anybody you could probably meet. The goal of this show today is to educate and help people better understand what annuities are and what they are not, and to clear up any misconceptions. I also stated in the previous segment there are many types of annuities: immediate, multi-year guarantees, fixed, variables, hybrids. But today I'm going to focus primarily on fixed index annuities, and we'll also touch on guaranteed lifetime income products. Now, what is an index annuity or growth annuity as I refer to? One, it has strong upside potential gains. We have products of 7.5 to as high as 15.5 average annual returns over a decade plus. There's no downside market risk. The principal is guaranteed. If the index goes down, you don't lose. This is one very strong, valuable benefit to an index annuity. Also, once gains are locked in, they become new principal. Therefore, your account values never go down as you move forward and lock in those gains. Some products even allow you to lock in your gains at any time. This is an extremely beneficial feature when we see a run-up in an index. You can lock it in. Also, with index annuities, all products, all companies benefit from tax-deferred growth. This means you pay taxes on the gains only when you withdraw funds. Therefore, you can defer taxes year to year if you choose. One of the most common misconceptions is that if you want guarantees, you have to give up strong returns. Nothing could be further from the truth. It is a myth. Now, annuities do suffer from the perception of poor performance. And the reason behind this is quite simple. For example, if you chose a stock and it happened to lose money, would you blame the entire stock market? Probably not. That would be silly. You chose a bad stock. I find it ironic how often people will have an experience with an annuity, have a poor result, and blame the entire industry. There are 3 primary reasons why people suffer from poor performance with index annuity products: caps and other limitations, poor performing indexes, they or their agent or advisor chose a poor performing index, and a low interest rate environment when they purchased the product. And this third and last is the one that's least understood by most people, including agents and advisors. How do you avoid poor performance? You want to work with an independent agent like myself. And the reason is simple. Having access to nearly every product available can ensure the best option for you. If an agent or advisor has a limited selection of products, they may or may not have the best product available. It's just that simple. And the industry tells us that about 10% of agents and advisors are independent. This means if you've met with or worked with an agent or advisor regarding an annuity product, there's a 90% chance, roughly, that you were offered or presented a limited selection of products. It's shocking how often I meet with someone who owns an annuity, and when I ask them a few questions, they share they were only shown one, maybe two products. I think that if you had that experience, that's a pretty likely tell that that agent or advisor has a limited selection of products. Now, granted, they may have some favorites, but if they cannot show you literally dozens of companies and hundreds of products available, most likely they're not independent. The first of two game-changing things that I do for my clients. If you meet with me, I will do a search based on your age, your state, and the amount you want to invest, and I will show you what is available. And most of the time, people are shocked to find out there are literally dozens of companies and hundreds of products available. 1, 2, 3, 400 different products available to them. The response I get most often is, wow, I had no idea. We can then also take that search and sort it by various criteria. Time frame, typically products available from anywhere from as little as 3 years to as long as 15. Which products have the most upside potential gains? What's the highest bonus available? And various other criteria. Again, I will show you the search. I'll show you what I see. And it's very eye-opening and game-changing for most people. Now, a very popular analogy I've been using is, if you want to win a horse race, you need a fast horse and a good jockey. And this is the second primary game-changing thing I do for my clients. In addition to there typically being hundreds of products available, there are also hundreds of indexes available. I have access to index performance reports. This is proprietary software. I'm told by the software company that less than 1% of agents and advisors have access to this information. Most are not even aware it exists. And I get asked all the time, why do more advisors not have access to this info? The company that generates this uses this as an incentive or carrot to work with them. So they don't want everybody to have it. That's the reason. Index performance reports are updated monthly, and they show the 1, 5, and 10-year average annual returns of these hundreds of indexes. Again, I will show this to you if you meet with me. You will quickly see that about 80% of these indexes average low single-digit returns over the past decade, for example. And about 20% average 10% plus returns over the past decade. This is one of the biggest reasons why so many annuity owners have suffered with poor performance. They're in a poor performing index. If you're in an index that's averaged 3, 4, 5% over the past decade, why would you expect stronger returns than that? And without this information, most of it is not public record. It's difficult to obtain. In most cases, the agent or advisor themselves don't actually know what the actual returns have been. Now, I'm not here to pick on agents and advisors. Most of them, I believe, genuinely want their clients to do well. But without the information, you're kind of flying blind. Earlier in my career, when I did not have access to this info, I was flying blind as well. I want you to understand how game-changing this really is. By being able to identify the indexes that have averaged 10, 12, even 15% average annual returns over the past decade plus, the odds of you increasing your returns increase exponentially. Now, there's no guarantee a strong performing index will out-return a poor performer next year, for example. But if you're looking at two different indexes, one has averaged 3% a year for the past decade, perhaps has never done more than 5 or 6% ever in any given year, and you have a different index that's averaged 10, 12% or plus per year on average, has returned 20% plus in certain years, what are the odds of the poor performer outdoing the strong performer in any given year. They're quite low. We're playing the odds here, folks. And this is why most of the time you're going to see 2, 3, and even 4-fold higher returns on average per year than what you were receiving previously in an existing annuity product or other investment for that matter. So the first and foremost thing that we do that's game-changing to ensure strong performance with guarantees is to make sure you're invested in strong indexes that have had strong historical performance and will likely to continue to do that in the future. And that is the horse, the fast horse. Do you want to be in a racehorse or a plow horse? That's the index. In the next segment, I'm going to discuss the jockey. A good jockey can encourage a horse to go faster or rein them in and slow them down.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422.
This is Ference, host of the Your Personal Bank Show. My show focuses on creating tax-free buckets of money, insured, guaranteed, highly liquid, and the ability to create positive arbitrage. Did you know this is the best time in over 40 years to invest in index annuities? An index annuity allows you to 1. Grow your money safely without market risk. Once gains are locked in, they're guaranteed against future market loss. 2. Double-digit potential upside on good market years with no losses in bad years. Principal is guaranteed. 3. A 7 to 8% fixed interest option is available in the first year. If you're interested in growing your money with potential index-related gains without downside market risk, this is the best time in over 40 years to consider an annuity. If your annuity is over 2 years old, the newer products likely have far superior potential returns. Please contact me at yourpersonalbank.com or 866-268-4422 for more info. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Email Ference, F-E-R-E-N-C, at yourpersonalbank.com or 866-268-4422. And yes, you will reach me, not an assistant. Today we've been discussing why this is the best time in 40 plus years to consider an annuity, or if you own one, to transfer your annuity. I discussed my background in the first segment, 27 plus years of experience, one of the top 10 annuity producers nationally, multiple years. I've been an agency owner, trained over 100 agents, worked with over 1,000 clients in my career. I've been involved in a product design team with a major insurance company developing an annuity product from scratch. There's few people in this country who have more experience with annuities than myself. Not saying that to brag, it's a fact, and maybe it'll help build a little credibility to help you understand where I'm coming from. Last segment, I shared one of the primary reasons why many people have suffered poor performance in annuity products previously. They're in a poor performing index. The Index Performance Report lists hundreds of indexes, the 1, 5, 10-year history, actual returns. This is proprietary information I will share with you if you meet with me. And I'll show you the indexes that have generated the strongest returns historically. And it's the old 80-20 rule. About 80% of indexes have averaged low single-digit returns over the past decade or more, and about 20% have averaged 10, 12, even 15% average annual returns over the past decade or more. Some of those have even returned as high as 27% in 1 year alone, with no downside risk. Another question I get all the time. These are net actual returns in your account. How to ensure strong performance? The analogy I used is if you want to win a horse race, you need a fast horse and a good jockey. And a strong index is the horse. You want a racehorse versus a plow horse. With that index performance report, we're able to identify the racehorses, the ones that are most likely to continue to have strong returns. The other key component is the jockey. A jockey can slow down, rein in a fast horse, or encourage it along and speed it up. Now, the jockey is the product itself. And the products include fees, caps, and participation rates. And these three things are very important to understand with any index product, whether it's an index annuity or index universal life product. And this can be the difference of a strong performer versus a poor performer. The second most common reason why people suffer from poor returns in index products are these three things: fees, caps, and participation rates. Fees are easy. You want a product with low or no fees. Obviously, the higher the fees, the less gain you receive. And yes, we do have many no-fee products. And while I'm on the subject of fees, I don't charge a fee either. It's very uncommon. Most people are surprised by that. Once I explain how I get paid, then it makes sense. I'm sure you can appreciate, regardless of what a financial person calls themselves or what title they use, if they recommend a financial product to you, in most cases, they're going to get paid by the company in some way. And in most cases, that is paid in a commission. I get commissions from the companies also, just like anyone else. Many agents and advisors also charge additional fees. I have chose 27 years ago not to do that. If you're not being charged 1% fee per year, for example, in 10 years, you have 10% more money in your pocket without compounding. My clients like that. I don't cost you anything. In fact, any investment you make in these index annuity products, 100% of the money you contribute goes to work right away. This is a very commonly misunderstood aspect of index annuities. From a fee standpoint, they are a very, very strong option. So in summary, you want to have low or no fees. I will grant you, on occasion, when having a low fee can be beneficial if it increases your upside potential gains. I'll share more on that in a couple of minutes. The next part of the jockey or the product is caps. Now, caps are exactly what they sound like. They limit your upside. And this is probably the second most common reason why people suffer poor performance in index products. The first is being in poor indexes, so poor performers, slow horses. The second one is caps, limiting or reining in the potential growth. I am not a fan of caps. Many prospective clients have shared with me that they have been told that all index annuity or IULs have caps. That is absolutely untrue. It's false. I will show you dozens of companies and even 100 products or more potentially without any caps. No cap means unlimited upside. I am not a fan of caps. If you have a cap below 10% annual, in my opinion, is way, way too low. You should contact me at yourpersonalbank.com. Get rid of that limiting factor to your upside. Now, there are many types of caps. There are annual caps, monthly caps. I run into commonly people with existing index annuity products with annual cap rates of 5% or 3% or even lower sometimes. I had one client recently, was an S&P 500 index. It had on the statement showed over 25% return the previous year. That's a great index. That's a fast horse, one of my favorite to use for clients. But he had a 2.8% annual cap. What does that mean? Even though the index went up 25% that year, he only received 2.8% credit. That's pathetic. I see this every week, folks, and this is the reason why so many people are suffering poor performance. You do not have to subject yourself to that and continue to suffer that poor performance. Monthly caps have a higher potential upside, but have a real downside that most people do not understand. Most monthly caps I see are around 1 to 2% per month. What does that mean? It means your index could earn up to 1 or 2% per month. So theoretically, in a year, if the index went up in a straight line, you could earn 12 or 24% in 1 year. The problem is that's theoretical versus reality. The reality is indexes and the markets do not go in a straight line. If you look at any given year, they're up, down, and sideways nearly every month. And the other part that most people do not understand about monthly caps is the upside cap is limited, as I stated, 1 to 2% typically, but the downside is not. Now, to be clear, all index annuity products and IULs, index universal life products, all companies, all products guarantee the downside. They guarantee the principal against loss, which is a good thing. But for calculation purposes, if you have a monthly cap product, and for example, your upside cap is 1%, your upside potential is 1% per month, your downside for calculation purposes is not capped. Let me use an example. Let's assume you had 10 good months and 2 poor months in a given year. Your upside gain on a 1% monthly cap would be 1% per month, or 10 good months would be 10% upside credit. But let's assume your 2 poor months lost 4% each month. Can indexes in the markets drop 4% in a month? Absolutely. In fact, that's normal. Oftentimes they can drop much more than that. But in our example, we use 4% negative times 2, that's negative 8%, against your 10% of gains. Your net credit at the end of that year would be 2%. I had a client meet recently who was in a strong index, fast horse. That index had returned over 20% the previous year. They had a 2% monthly cap product. Turns out they had 11 really good months that year and 1 really bad one. Their net credit result at the end of the year, 3%. Because the 1 bad month wiped out all the up months, and again, all the up months for crediting purposes were capped or limited. This might help you understand a little better why I am not a fan of caps. In the vast majority of cases, I recommend no cap products, unlimited upside. Why limit your upside? If you have an index annuity product that you're considering or own one, and you have annual or monthly caps, annual caps below 10%, and frankly, just about any monthly cap product, you should contact me at yourpersonalbank.com. Email me at Ferenc, F-E-R-E-N-C, at yourpersonalbank.com. We discussed indexes. You want strong performing indexes. You want fast horses. Index Performance Report, the 1, 5, and 10-year results, helps us identify which ones are the most likely to continue those strong results. You want low fees or no fees? Fees eat into your gains. Lower the better. You don't want caps. Caps limit your upside. No caps are ideal. If you have a cap, it needs to be really high, 10% or higher annually. Monthly caps probably need to be at least 3 or 4% per month or higher to even consider, but I'm really not a fan of monthly cap for the most part. The last thing is participation rates. And what is a participation rate? It's the percentage of credit you receive on the index. Let me use an example. Let's assume your index went up 10% in a given year, and you had a 100% participation rate. That means your credit would be 10%, assuming you didn't have any fees or caps. Obviously, the higher the participation rate, the better. I've seen participation rates as low as 20%. So you can quickly see a low participation rate can really throttle or rein in the jockey slowing down that horse. Even though you may have a great index, with a low participation rate, it really slows down your gains. We have products today with 180 to 185% 1-year participation rates. What does that mean? That's a jockey that's spurring the horse on. If your index in any given year received 10%, for example, your credit that year would be 18 or 18.5%. This is often how we outperform the indexes with a strong participation rate, and how we obtain years where clients receive 20% returns in a single year, for example. The key I want you to understand with all of this is it's not any one of those things, the index, the fees, the caps, or participation rates. It's a combination of all 4. We want the best combination of the 4 to determine the best upside potential. And in 99% plus cases that I deal with of existing index annuity products and index universal life products, The current indexes, fees, caps, and participation rates are so far superior to the existing products that the average returns with the new products are double, triple, and sometimes even quadruple of the existing product. It's the best time in over 40 years to consider an annuity or to transfer an existing annuity to a new one. And the reason behind it has to do with the least understood aspect of why this is the golden era of fixed assets and why index annuity products and index universal life products are performing so much better than they were even 2 or 3 years ago. And it has to do with long-term bond yields. Stay tuned in the next segment and you'll have a better understanding of why.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422.
I'm Ference Toth, host of the Your Personal Bank Show. This is the golden era of fixed assets. Annuities and guaranteed lifetime income are paying the best rates in over 40 years. If you looked at annuities over 2 years ago, the numbers have increased significantly. If you own an annuity over 2 years old, the new products can not only pay your penalty to switch, but are often guaranteed to outperform your current product. For more info, contact me at yourpersonalbank.com or 866-268-4422. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Email Ference, F-E-R-E-N-C, at yourpersonalbank.com or 866-268-4422. Yes, you will reach me, not an assistant. Today we've been discussing why this is the best time in 40 plus years to consider an annuity or transfer your existing annuity that you may own. I shared my background, 27-year history, being one of the top 10 annuity producers nationally, multiple years. I've been on a product development team creating an annuity product for a major insurance company with the head actuary, head of product development, and head of legal. This is an experience that was very rare, helped me understand everything under the hood and why some annuities produce and others do not, why some get returns and others don't. We discussed the 4 key items that need to be in place to maximize returns and avoid poor performance. You have to have a strong index. The index performance reports, proprietary information helps us identify that. About 80% of indexes out there are poor performers, low single digits over the past 10 years. About 20% have averaged 10, 12, and even 15% average annual returns for the past decade plus. I will show you those. We can identify those. But not only do you have to have a good index or a fast horse, if you want to win that horse race, you also need a good jockey, the product. You have to have a good combination of low or no fees, no caps, ideally. And yes, there are many products available with no caps. I'll show you dozens, if not hundreds, literally. And strong participation rates. Many of these participation rates are upwards of 180% participation rates for a 1-year product, which means it spurs that index on. If that index generates a 10% return, your credit would be 18% in that example. And this is how we have helped clients obtain high as 27% returns in 1 year in an index annuity product or index universal life. The last thing I want to share to help you understand why this is the best time in over 40 years for index products, why it's the golden age of fixed assets, has to do with understanding what do these companies do when you invest your money with them. Well, typically an annuity company is going to put majority of the funds you give them and buy a bond, and they're going to put that bond in their safe and never touch it. This is how they guarantee the principal. The bond is insured and guaranteed and in their safe, and they never touch it. The bond pays interest. They take the interest from the bond and purchase options. Options investing can be high risk, especially if you're investing principal. Again, the insurance companies are not touching the principal, the interest only. An option can increase exponentially. If a $10 stock goes to 11, you make 10%. But if you buy an option on that $10 stock, and let's say you pay $1 and that stock goes from 10 to 11, the option can go from $1 to $2 in value, which is 100% return. Options can increase in a year 100, 200, 300% or more even. This is how exponential gains can be obtained in a small amount of money. If you're only playing with the interest, you're not risking the principal. This is how the insurance companies eliminate the risk. The other scenario is if the underlying asset goes down in value, the option will expire worthless. If that happens, does the insurance company owe you any money? No. You get no return that year, even though the index or the market or whatever went down. Obviously, what does the bond do the following year? Pays more interest, they buy more options, and they repeat the process. This is what index annuity companies do for the most part. This is how they can obtain strong returns without any downside market risk. If you had billions of dollars, had access to the bond auctions, and had an options trading desk, you could duplicate that process. Most people don't have access to those tools. So these insurance companies are giving you access to institutional investing tools to get the strong returns with no downside risk. And that dispels one of the most common myths, that if you want guarantees, you have to give up strong returns. It's not true. You just have to have the right index, strong performing indexes with low or no fees, no caps, and strong participation rates. I will show you those options, those products. And this is why we have products that have averaged 7.5% to 15.5% average annual returns for 10, 15, even 20 years. Actual returns, net, in your account. Now that you understand this, here's the key. Remember, the insurance company's buying these bonds. Typically, they buy 20, 30-year bonds that pay interest. And that's locked in for the next 20, 30 years. So nothing's going to change. What were interest rates in 2022 or prior? They were very low. For example, a 30-year treasury was paying less than 2%. If you invested in an index annuity product or index universal life product in 2022 or earlier, the insurance company bought that bond, got a little bit low interest from the bond. They have a limited amount of money to work with to buy the options. Therefore, the returns will be more limited. If you roll over or transfer that index universal life or index annuity to a new one, the company can then buy a new bond. For example, 30-year treasuries are about 5% today, which is 2.5 times or 250% more interest, which means the companies can buy 2.5 times or 250% more options, which means on average 2.5 times more returns for you. This is why I see consistently returns from people who had existing annuities previous years. We do their first year review and they will receive 2, 3, 4. I have seen as high as 10-fold increase in the first year, not bonuses, actual returns over what they earned in the previous 5 years, 10 years even. This is math. And this is not something that's changing anytime soon. This is a fundamental economic change with long-term bond yields and interest rates. And remember, if you have the index product purchased in 2022 or earlier, it's not like that bond that company purchased is going to pay more interest suddenly. No, it's locked in for the next 20, 30 years. And the new product, new bond they purchased, is also locked in for the next 20 or 30 years. So it doesn't matter what the economy does or interest rates or anything that matter in the future. Your stronger, higher returns will continue because the company can continue to buy more options because they have more interest to work with. Also, this is likely not to change anytime soon because the higher bond yields are primarily being caused by the high federal debt. And until Congress gets their financial house in order and starts reducing that debt, higher bond yields will most likely continue. There's no sign of that changing anytime in the near future. This is why most financial professionals, economists understand and have stated that this higher for longer interest rate environment due to high bond yields will likely continue for the next decade or longer, basically for the next foreseeable future. This is why it's the best time in over 40 years to consider an annuity or transfer your existing annuity purchased 2022 or earlier. It's math, it's interest rates, it's bond yields. One other question I get often is about bonuses. You need to understand there's no free lunch. If a company's going to give you a large bonus, they're going to have to take something away. The takeaway is going to be less growth in the future. On average, if I recommend a product with a bonus, we have products today with 26% bonuses and even higher in some cases, up to age 89 in most states. If a company's going to pay you that large bonus, they're going to reduce your upside potential growth, either through more fees. Again, I'm not a fan of caps, or lower participation rates. What I typically see as a high bonus product, returns are about a half to 2/3 per year on average versus a non-bonus product. Now, is there a time and place to use bonuses? Yes. One is if you have an existing annuity product you purchased in 2022 or earlier, and you're stuck with this low returns because the bond that was purchased at the time is paying poor interest, limited options, limited potential growth, and you want to get a new one to increase your returns by 2-3-fold likely, but you have a penalty to get out of the old one, well, the big bonus can offset the penalty. Now you're ahead day one. For example, if you have a 10% penalty, which is a fairly high penalty, but you get a 26% bonus, you can see quickly you're well ahead on your account value day one, and your potential upside is probably double of your older product. So it's a win-win. The other time I see bonuses make sense for people is typically when they have a shorter time horizon, shorter time frame. Often this is when somebody's older, maybe in their mid-80s or older even. Obtaining a big bonus can make a lot of sense because a large bonus product is probably going to have more money in it in the first 5 or 6 years than a non-bonus product. So your time horizon can help dictate whether a bonus makes sense versus a non-bonus product. Now, the last thing I want to share is I had a recent prospective client send me an AI analysis about index annuity products, and I found it highly enlightening. And I want to share this because this also encompasses many other questions that I receive from people. And this AI analysis had clearly some factual information, but unfortunately left out a lot of missing pieces, which led to a lack of understanding of the benefits of the product. First of all, it pointed out the strengths of the index annuity product is guaranteed, no downside market risk. It really stressed on the limited upside potential performance of the typical index annuity product. And it discussed things like fees, caps, and low participation rates. Earlier in the show, I addressed all of those issues and showed where having low or no fees, eliminating caps, and having strong participation rates with a strong index eliminates that problem and ensures you have, in most cases, 2, 3, and 4-fold the average annual returns of what's typical industry-wide. So this is how we eliminate the concerns the AI analysis had. It also pointed out in the AI analysis that the bonus could not be withdrawn immediately. Granted, that is a fact, but what it missed was that the bonus made the account value much higher day one, which means future growth was much higher. So unless you're needing a large amount of liquidity right away, if you want to maximize your returns, that's a clear benefit. The other point that the AI analysis brought up was the liquidity. The two big limitations of index annuity products, I stated earlier, is many suffer from poor performance. We've discussed how having strong indexes, low fees, no caps, strong participation rates, we mitigate that problem and we maximize returns 2, 3, 4-fold oftentimes. The other one is most annuities allow 10% free withdrawals per year. Some will allow 20% after 2 years or even 30% after 3 years, but that's the typical norm. Now, my response to that is if you were to put all of your money into an annuity and you needed more than 10% per year, that's probably not the best fit for you. You probably should not contribute all of your money into annuity. A portion of it could make sense, but not necessarily all of it. If you're taking out more than 10% of your account value each year, let's say in retirement, you're probably going to run out of money before you run out of time. The financial industry typically recommends the 4% withdrawal rule, And if you stick to more commonly recommended withdrawal rates, then the 10% free withdrawals per year in the annuity poses no problem. And the fact you can get strong upside growth with no downside risk often offsets the limitation of the liquidity. Again, if you're concerned about having access to some funds, set aside some funds that are more liquid for those types of concerns. But it doesn't mean to reject outright index annuity product because it doesn't have the full liquidity that other financial products have. Again, it's identifying your financial goals, your stage of life. Is risk mitigation a concern? Maximizing income, for example, and finding that right balance. This AI analysis, and I see this as a common mistake that investors make. This is coming from a college-certified financial literacy course I taught for a while. Is this all or nothing approach or attitude? It doesn't make sense for most people to have all or nothing, everything in one bucket. You should have multiple buckets. You should have a short-term bucket that has safety and liquidity, a medium-term bucket for emergencies, and then a longer-term bucket to maximize returns and minimize risk and taxes if possible. These are the approaches that we take with people. There's no cookie-cutter approach. Each person is different, their financial goals, their stage of life, what they want to accomplish, and we try to find the best tool, the best fit for their goals. I hope you found this educational. I encourage you to pass this on to anyone you think may be interested. If you want a copy or transcript of this show, email me at Ferenc, F-E-R-E-N-C, @yourpersonalbank.com. Please contact me if you have additional questions or would like to look at your situation further. Stay tuned next week to the Your Personal Bank Show for more great information. And as long as it's on our money, in God we trust.
This is Ferenc, host of the Your Personal Bank Show. My show focuses on creating tax-free buckets of money, insured, guaranteed, highly liquid, and the ability to create positive arbitrage. Did you know this is the best time in over 40 years to invest in index annuities? An index annuity allows you to 1. Grow your money safely without market risk. Once gains are locked in, they're guaranteed against future market loss. 2. Double-digit potential upside on good market years with no losses in bad years. Principal is guaranteed. 3. A 7 to 8% fixed interest option is available in the first year. If you're interested in growing your money with potential index-related gains without downside market risk, this is the best time in over 40 years to consider an annuity. If your annuity is over 2 years old, the newer products likely have far superior potential returns. Please contact me at yourpersonalbank.com or 866-268-4422 for more info. That's yourpersonalbank.com.
Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. This show is designed to provide accurate and authoritative information. The presenter and guests of this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. There may be charges when replacing coverage. Dividend rates and bank line of credit rates may change. For current rates, contact Ferenc at 866-268-4422 or yourpersonalbank.com. Again, that's 866-268-4422 or yourpersonalbank.com.
Concerned about market risk? I'm Ferenc Toth, host of the Your Personal Bank Show. The S&P 500 valuations are higher than at any time ever recorded in stock market history. This includes 1929 and 1999. We all know what happened afterwards. It wasn't pretty. Elevated valuations increase risk to the downside. Annuities and Your Personal Bank offer unlimited upside with no downside market risk. Your principal is guaranteed. Contact Ferenc at yourpersonalbank.com to maximize returns, reduce market risk, increase liquidity, and reduce taxes.